What if I told you that tens of thousands of regular people, not Wall Street insiders, not millionaires, are getting paid every single month just for owning certain stocks? They wake up, check their account, and money has already been deposited. No extra hours worked. No side hustle. Just passive income flowing in like clockwork. That's the power of dividend investing. And in this video, I'm going to break down exactly how it works, which stocks and funds you need to know about, and how you can engineer your own monthly dividend income stream, even if you're starting from scratch. If you want to build real passive income, smash that like button, and if this is your first time here, subscribe and hit the bell so you never miss a video that could change your financial future. Profit, reinvest, shareholders, dividend. Let's start with the basics. What exactly is a dividend? When a company makes a profit, it has a choice. It can reinvest all that money back into the business, or it can share a portion of those profits with the people who own shares of the company. That shared profit is called a dividend. Think of it like being a landlord. You own the property, in this case, the stock, and your tenant, the company, pays you rent every month or every quarter. You didn't have to do anything extra, you just own the asset. And in a gentle loop. Now here's where it gets interesting. Most dividends are paid quarterly. That's 4 times a year. But here's the trick most people miss. If you build your portfolio the right way, you can get paid every single month. We'll get to exactly how to do that in just a minute. And that yield is essentially your return just from dividends, before your stock even goes up in value. Pretty powerful, right? Most stocks pay dividends quarterly, January, April, July, October. That's fine. But what if your bills come every month? What if you want to use this income to pay your rent, your groceries, your subscriptions? That's where the strategy of stacking multiple dividend sources comes in. There are actually stocks and funds that pay you every single month, and by combining those with quarterly payers whose schedules don't overlap, you can engineer a full 12-month income stream. Let me show you exactly how this works with 2 different approaches. Approach 1, monthly dividend payers. There are funds and stocks built specifically to pay monthly. Here are the 3 categories to know: monthly dividend ETFs and funds. These investment funds pool many dividend-paying assets and distribute income monthly. Examples include funds that hold hundreds of dividend-paying stocks across sectors, real estate, utilities, energy, financials, and pass the income directly to you every 30 days. REITs, Real Estate Investment Trusts. By law, REITs must pay out at least 90% of taxable income as dividends. Many pay monthly. REITs let you be a real estate investor without buying a single property. You can own a piece of shopping centers, apartment complexes, hospitals, cell towers, and collect rent income from all of them. BDCs, business development companies, similar to REITs but for private loans to small businesses, high yields, monthly payments common. Print 2. Stacking quarterly payers. Now here's the genius move that most beginner investors don't know about. Different companies pay their quarterly dividends in different months. So if you own stock A that pays in January, April, July, and October, and stock B that pays in February, May, August, November, and stock C that pays in March, June, September, December, you're getting paid every single month, and you never had to find a single monthly paying stock. Alright, let's talk about the actual types of investments you should know about as a dividend investor. I'm not going to give you specific stock picks. Remember, this is not financial advice, but I'm going to give you the categories and what to look for within each one. Dividend aristocrats are companies in the S&P 500 that have raised their dividend every single year for at least 25 consecutive years. Dividend kings have done it for 50 years or more. Think about what that means. Through recessions, pandemics, market crashes. These companies kept raising what they paid shareholders. That's the kind of consistency that lets you sleep at night. These tend to be large, stable companies in sectors like consumer staples, healthcare, and industrials. Their yields might not be the highest, often 2 to 4%, but the reliability and dividend growth make them powerful long-term holds. ETFs, exchange-traded funds, are baskets of stocks you buy as a single investment. A dividend ETF specifically targets companies that pay above-average dividends. The benefit here is instant diversification. Instead of putting all your eggs in one company's basket, you own a slice of 50, 100, even 500 dividend-paying companies at once. If one cuts its dividend, the others cushion the blow. Yields on quality dividend ETFs typically range from 3% to 6%. Some specialty high-yield ETFs go even higher, though they often come with higher risk, and that's the trade-off you always need to evaluate. We touched on rates earlier, but let's go deeper. There are different types of rates: residential, commercial, industrial, healthcare, data centers, even cell towers. The trade-off: rates can be more sensitive to interest rate changes. When rates go up, rate prices sometimes go down. But for long-term income investors who reinvest dividends, short-term price fluctuations matter less than the income consistency. This is a slightly more advanced category that's exploded in popularity. Covered call ETFs, sometimes called option income funds, hold stocks and sell options contracts on those stocks to generate extra income. That extra premium gets paid out to shareholders, often monthly and at very high yields. Yields of 8%, 10%, even 12% or more are common here. But, and this is important, because of how options work, these funds sometimes grow their stock value more slowly than a traditional index fund. They're income machines, not necessarily growth machines. Whether that trade-off makes sense depends entirely on your goals. Are you trying to maximize income now, or grow wealth over 30 years? Know your timeline before choosing. Let's talk real numbers, because one of the most common questions I see is, how much money do I actually need to make meaningful monthly income from dividends? Let's run some scenarios, and I'll use simple round numbers to make the math clean. The dividend math formula, a monthly income, which spouts portfolio value x annual yield, which spouts 12. Scenario 1, if you have $10,000 invested at an average yield of 5%, $10,000 x 5%, or $500 year, bao 12 thousands 42-month scenario. 2, $50,000 at 5% yield, $50,000 x 5%, or $2,500, it's always $208-month scenario. 3, $100,000 at 5% yield, $100,000 at 5%, $5,500 for 17-month scenario. 4, $500,000 at 5% yield, $500,000 at 5%, $25,000 year, 12 and 2,083 month. Now those numbers might look big or small depending on where you are in life, but here's the most important concept in this entire video. DRIP, Dividend Reinvestment Plan. Instead of taking your dividends as cash, automatically reinvest them to buy more shares. Over time, this creates compounding growth that accelerates your income. Here's the magic of compounding. If you start with $1,000 and add $200 per month, reinvesting every dividend at a 5% annual yield, after 10 years you'd have dramatically more income than if you spent those dividends. After 20 years, the difference is staggering. The earlier you start, the more time compounds your money. That's not a cliche, it's mathematics. Even small amounts, reinvested consistently, can grow into serious income over a 10-20 year horizon. Alright, let's put this all together. Here's a simple framework for building a portfolio designed to generate monthly dividend income. Step 1, define your goal. Before you buy a single share, know your why. Are you building income for retirement? Supplementing your current income? Trying to eventually replace your salary? Your goal determines your strategy, specifically how much you prioritize high yield now versus growth for later. Where you hold your dividend investments matters. In a tax-advantaged account like a Roth IRA, your dividend income can grow completely tax-free. In a traditional IRA or 401k, taxes are deferred until withdrawal. In a regular brokerage account, you'll owe taxes on dividends each year. For most people building long-term dividend income, maxing out tax-advantaged accounts first is a smart move, but every situation is different, which is why a financial advisor can be valuable here. Step 3, build your core. Diversify across categories. Think of your portfolio in layers. Your core might be broad dividend ETFs, stable, diversified, lower yield, but reliable. Then you add satellite positions, REITs, BDCs, or covered call ETFs, to boost income and fill monthly payment gaps. Once you know what you're holding, look at when each position pays. Build your actual calendar, write it out, put it in a spreadsheet, and see which months are thin. Then fill the gaps with monthly payers or different quarterly cycles. Step 5, stay consistent. Automate and review. Quarterly automate your contributions. Set up automatic investments monthly, even if it's $50. Turn on DRIP for any positions you're not withdrawing from yet. And review your portfolio quarterly to make sure your dividend income is growing and nothing concerning has changed with any of your holdings. Mistake 1, chasing the highest yield. A 15% or 20% dividend yield sounds incredible, but it's almost always a warning sign. Ultra-high yields often indicate that the stock price has crashed because the market expects the dividend to be cut. Getting a big yield this month and then watching it disappear next quarter is far worse than a steady 5%. Mistake 2. Ignoring dividend safety. Before you buy any dividend stock, always check the payout ratio. That's the percentage of earnings being paid as dividends. A payout ratio above 80–90% can mean the company is paying out more than it comfortably earns, which often leads to a dividend cut. Look for companies with room to sustain and grow the dividend. Mistake 3. No. Diversification. Don't put 80% of your money into one sector because the yields happen to be high right now. Sectors rotate. Energy, utilities, financials all have cycles. Diversifying across sectors protects your income stream when one area hits a rough patch. Mistake 4. Forgetting about taxes. Dividends are taxable income. Qualified dividends from U.S. stocks held for a minimum period are taxed at lower capital gains rates, but non-qualified dividends, REIT dividends, and BDC dividends are often taxed as ordinary income. Know what category your dividends fall into so you're not surprised at tax time. Mistake 5. Selling too early. Dividend investing rewards patience. If the market drops 20% and your stock is still paying its dividend, that's actually an opportunity. You're now buying shares at a discount and locking in a higher yield. The investors who panic sell are the ones who miss the compounding. So let's recap what we covered today. Dividends are your share of a company's profits, passive income deposited directly into your account. By combining monthly dividend payers with strategically chosen quarterly stocks, you can build a portfolio that pays you every single month. You learned the categories: dividend aristocrats for reliability, high-yield ETFs for diversified income, REITs for real estate income, and covered call ETFs for maximum monthly cash flow. You saw the math, how compounding and reinvesting turns small, consistent investments into serious income over time. And you know the mistakes to avoid so you don't derail your own progress. The most important thing I want you to take away from this video is this: you don't need to be rich to start. You just need to start. Every dividend you earn, every share you reinvest, every month that passes, it's building something real. The best time to start was 10 years ago. The second best time is right now. Like this video if it helped you understand dividends. Subscribe and hit the bell. New financial education videos every week. Drop a comment. What's your monthly dividend income goal?